quickly. So, Pinnacle started by funding single asset projects. We've now funded 10 QOZB projects in Washington and California, over 1,500 units of workforce and market rate housing, student housing, two adaptive reuse projects. So as Jeff mentioned, we were early movers in the OZ space. We used what we know of as the best, legal and tax counsel in our market to help us set up those projects. And frankly, it was a couple of our largest investors really prompted us by saying, well, we really like what you're doing and how you're sourcing projects, but we really would like to see a diversified portfolio that we could invest in one fund in multiple projects outside of Washington and California primarily, because they're overly invested there already. And that's really what started here. And the first thing we did, with Pinnacle is hire Sandy Heffernan, our CFO, who's the lifeblood of our company, because reporting and investor outreach is everything, right? And back office. In the OZ world, as Sandy mentioned, tax and of course you would say legal are critical, and structuring is everything. And we kept hearing about Sandy Person as the go-to fund, attorney. So we hired the best of the best. And same thing with Novogradac. We'd already worked with them on some of our projects. And when we look at real estate projects, you heard a lot about opportunity zones. My role and our partner, Jill Homan, who will be on our next webinar, Jill and I are really in charge of sourcing projects, underwriting the projects with our experts, and then executing on our JV plans. We really don't even look at the OZ benefits at all. All of our underwriting is without the OZs, and we look at the experts to make sure we're structuring the right way and keeping our investors' investments sound. But we look at the real estate on its own. And what we set off to do was to look at some of the top markets in the country to have a diversified portfolio of multifamily assets, a fund of 4, about 120 million of equity. That was our goal that we launched last December. We wanted to be the most fund-friendly, LP-friendly fund. And with Sandy's help, we think we set that up. We wanted to be very transparent to our LPs. And I'm going to be somewhat short in our review of our projects because Jill and I are available for reviews directly to investors to go over our portfolio. We did not want to be a blind pool fund. There are a lot of the aggregators out there, funds that are raising hundreds of millions of dollars. And Sandy, I like what you said, we're a bespoke fund. We wanted to raise equity for 4 projects of size and scale that we knew we could execute on. And right when we launched the fund in December and January, we had our first project locked in and closed our second project. And today we're proud to announce we have all 4 projects identified and closing our JVs on the final 2 to get to our fund of 4. So we are really focused in, market rate, single family, and now you'll hear build to rent is also a product type that we're very interested in and have one project for our portfolio. We looked at, no surprise, growth markets around the country where there's employment growth, people are moving for quality of life, and then where your wages, high wages to cost of real estate. So focusing throughout the Southeast, mountain states, and the Southwest were markets we were focused in. You see here on the map, the markets we looked at. Jill and I looked at, I bet you we looked at over 100 projects. We probably underwrote maybe 25 to 30 projects to get to the 4 projects now that we're locking in for the fund. So again, we like to be at major employers close by, universities close by. We like urban markets, and you'll see in the last 2 projects why we think maybe more suburban markets make sense in today's economy. And the perfect story for us is if a developer already owns a property or has a property tied up and didn't even know it was an opportunity zone. I bet you 80% of our projects, the developer didn't even know it was an opportunity zone. Which is a perfect story for us because again, we don't look at the benefits of the OZs other than that's the equity we bring to the project and we structure it that way. So the 4 markets that we are locked into, Denver, We had early on, I think early last year, we went and had our JV formed with Mortensen Development. Proud to announce we just closed on land yesterday on that project. We didn't have to close on land for about 9 months since we put together our partnership. And we've been working, Jill and I, closely, Jill more than I, on design and all, aspects of the development. We play a very active role with our joint venture partners, more than just bringing in equity. Sandy and their team helps us on all structuring of our JVs. And Jill and our analyst Wynn are really helping on the initial underwriting, and then really Jill's more oversight on unit mix. She's even doing colors and designs of amenity spaces. So we really are truly like an institutional partner for these developers. Mortensen Construction is a 57-year-old general construction company based in the Midwest. They've been in Denver for, I think, since 1981. So very strong in Denver. Their development manager has a lot of multifamily experience. This project is 200 units of multifamily podium product right next to the Denver Broncos Stadium in the Sun Valley neighborhood. Close to downtown, it's on the Platte River. There's another OZ project that's going to be built a couple blocks from us, which we like because it's a new upcoming neighborhood that's adjacent to downtown and the stadium district. So we think there's a lot of upside, for this marketplace. And we will have our building permits in December or January and break ground in February for that project. The second project is in Nashville. And, there's been a lot of news about Nashville over the last couple of years, a lot of growth. And frankly, as soon as we see, news like that, our radar's up, right? We don't want to be just in the same markets because everybody else is. But we met a sponsor. Jill knew this sponsor, Stillwater Capital, out of Dallas, and they hired a development manager that had been developing in Nashville for a number of years. And he sourced this site adjacent to the Titans Stadium. So no surprise, a lot of these stadium districts have industrial zones around them that are now being, looked at for, other types of uses, such as multifamily. This East Bank neighborhood is adjacent to downtown, right on the river. It's literally 5 minutes from Oracle's new major campus there with over 8,500 employees. This is also a mid-rise wrap product of about 375 units. And this developer is based in Dallas, and this is their first project here in Nashville for this development team, but their development partner has built many projects in Nashville, and they're emulating a project that was very successful in Dallas that they're bringing to the submarket. Both of these projects are what I would call market rate. We don't like to invest in high-rise premium units. It's more affordable market rate units for these cities. And I think this submarket will be, less than downtown. So people that are working at Oracle, people that want to walk to the stadium district, and close to the entertainment districts, this neighborhood is really going to be taking off. Now, these next two projects are our newest projects. We have term sheets executed for both, and joint venture documents are being drafted as we speak. And what's changed a little bit for us in our underwriting is it's getting very difficult to pencil market rate, mid-rise, and certainly high-rise projects in this market with construction costs and with interest rate environment and with rental rates kind of leveling out in some markets. We're being very careful on kind of what was our next third and fourth project. And we are, again, very fortunate to get introduced to a developer, another one out of Dallas, who had a site in Austin, Texas. And this is a site, a 12-acre site that they had already acquired off market to build garden style multifamily. And we think garden style is, it's very hard to find in opportunity zones that are close to urban areas because the land is too expensive. But in Austin, this particular site is about 15 minutes from downtown, 10 minutes from the airport, very close to Tesla's kind of mega complex there and Oracle. And it's a very large 350 unit garden style community. And again,
why don't you define garden style?
Garden style is surface parked.
Yeah, so you don't excavate.
So you don't have any excavation. You're typically 3 or 4 story max. And again, you're not building any structured parking. So it really kind of de-risks the entire construction process, both faster to deliver, less unknowns in the dirt. And the other thing is a diversification of product type, because these are now where most of our multifamily units are studios, 1 bedrooms, and some 2 bedrooms. These are primarily 1 bedrooms, 2 bedrooms, and 3 bedrooms that families are moving into from the smaller units. There's a big move from people wanting to be urban to be suburban, but close to downtown, because more people are working from home. They want amenities. So we're seeing a big push for people to move, to the suburban markets. This project, again, they own the land. We're in the design phase currently, and the plan is to break ground second or third quarter next year. And then the final project, Jeff and I and Jill were in Phoenix last 2 weeks ago, I believe, for an OZ conference. And we were introduced to a developer who has a lot of development experience, but they're a new group really going after the build for rent space. And we were very impressed with this group initially about kind of their delivery system and what they were focused in. But this particular market in Phoenix is 15 minutes from downtown and 5 minutes from Glendale, where their football stadium is located. It's a higher end suburban community that happened to be an opportunity zone. This is one of those stories that they didn't even know it was an opportunity zone. And they are really focused on, the single family for rent and townhomes for rent in this community. So this will be about 144 units. Again, they already own the land, and we're in the permit phase to basically do the site work early next year. And then we'll be going vertical, late next year, early the following for this, this product type, which again, garden style, we think is the continuum from, this mid-rise urban product and the single family build for rent with where the housing prices are today and interest rates, we think is going to be also the next boom for development. And we really like that in those Z markets that are, again, can stand on their own.
So just if I may, to clarify, so build to rent, or AKA BTR, is a very hot product type, particularly in this inflationary cycle where the cost to own a home and the mortgage associated with it now is, I think, ticked above 7%. And so this is for a young family desirous of both the space and a community and close to schools, but not able to afford ownership at the moment. These homes are being built for rent, not for sale.
That's correct. They're built for rent. And then, as in any, investment, you need to have an exit strategy, right? Because we're holding these for 10 years and there is a large market today. And we think will continue for institutions and private equity funds that are looking to acquire these assets. So you really want to have scale. So a project like this, it's not too different than a garden style community. They're looking for a rental product of scale that they can aggregate. So that's really what Jill and I have been working on heavily the last, several months, is this particular product type, because we think it really does de-risk the portfolio to have this different mix of uses, within our project, 4 projects.
So just in summary, Leo, as you mentioned, kind of hundreds, 100 plus deals reviewed and underwritten, or reviewed, I should say, 25 vetted and underwritten. The result now is this fund of 4 boutique, or bespoke, as Sandy called it, fund that's got a unique balance of product type and something we can execute on, and we think quite effectively.
Yeah, and I think the other thing, and again, Jill and I are available to discuss kind of our internal process. We have an extremely astute advisory board. CFO of one of the largest multifamily developers in the country is on our board, and Jill, is very conservative in her underwriting, and she has brought me along to be that way. I mean, we don't take a sponsor developer's underwriting and call that gospel. So we get our own market rents from our advisory board. Avenue 5 Residential is a large property management firm, so we use their rents that they believe are market. We grow rents and expenses very conservatively, We look at the interest rate environment and where we think it's going, and same thing with cap rates. So we're very conservative and sometimes too conservative. So we bring in our advisory board to really look at our underwriting, along the way, and they have done that for this portfolio.
Leo, can I speak to the advisory board for 1 second? Because it's kind of unique with you folks. Okay, everybody or most of these funds have an investor advisory board comprised just of investors to deal with the general partner when there's any issues that come up. They can deal with this advisory board, and your lead investors have already been appointed to that, so you have them looking over your shoulder. Secondly, though, the advisory board you're talking about is the GP advisory board that you guys created, that's paid for by you guys out of your share of the deal. It's paid for by you guys, and it's leading industry experts on the management and development side who are there as paid advisors to you folks to expand the team and get other points of view. So that's very unique with you folks. That GP advisory board.
Yeah, and that really kind of comes from Jeff's kind of technology background. I mean, putting together the best in class advisory board and helping, execute a business plan is new to real estate. And it's been critical for us, really, for growing Pinnacle, not only for sourcing of projects, helping underwrite projects. And we will continue with that model. You're right.
And you ate the cost of the board, despite
it comes out of our.
Yeah, you should have made it a partnership cost or a fund cost.
Yep.
So that's very generous of you folks and wise. I mean, it shows your attitude, I think, as a sponsor, which is very unique.
So at this point, we've talked about, again, the genesis of the program, the specific benefits, the possibility of extension of those benefits, our execution of the legislation as it's reflected by our fund of four, this boutique fund. And we heard about the size and scope of the program, eclipsing 100 billion and all the economic benefits associated with that. So we're coming to conclusion now, but we are stacking up a number of questions. Let me just launch a final poll question, if I may. Don't know. Nope, can't do that. So I will not launch that particular poll, but we are getting a variety of questions. The first one, John, you referred to the OZ tracks, some, maybe not at this time, meeting the criteria for low income, need for development, et cetera. So with the proposed legislation, do you expect any OZ tracks to be disqualified? And how would that affect any investment that's already taken place?
Yeah, so the proposed legislation, so a low income track's 80% AMI, okay? The proposed legislation says that anything that's in that 130% AMI over that is going to be discontinued as an opportunity zone. So there's it's a big spread from what the definition of low income community is. As far as the transition period, if you've already invested, if you have actually if you've actually spent money on a project, I think it's like $250,000 is the limit. Or even if you mention the project in some sort of SEC filing or similar filing, then it meets the transition rules where it still would be a good investment. So there's not a whole lot of risk, of good investments going bad.
Good. Okay, thank you.
Nobody's talking about disqualifying anything that's underway.
That's correct. And underway is a very flexible definition.
Sounds like $250,000 invested. Thank you, John and Sandy. Leo, question for you. How do you navigate the high interest rate environment? How do we?
Yeah, it's a good question. I mean, I guess the first and foremost, it's extremely critical as ever to be working with strong sponsors. Sponsors that have strong balance sheets, that have banking relationships. We're closing on our loan in Denver, and it was a very, very good loan for the time, but part of it was because of Mortensen and their background, very large GC and developer, and they bring in a business relationship. And from what we're hearing is most banks today are lending to relationship clients, not so much for non-relationship. So that's one thing we're doing. We just passed on a project because we didn't think the sponsor was strong enough to bring a loan that was, compelling for the project. Second is bringing more equity to projects as long as it's accretive to the deal. So maybe where we were 60 to 70% loan to cost, we're now closer to 50 to 55% loan to cost. So you're getting more competitive debt, with less leverage. So that's really that, we're looking at markets again that we think, that we come in with upside, and, we're being very careful, right? Where a lot of rent growth, everybody's smart when interest rates were low and rents kept going up. So we're just being very careful in the markets we're going into that we think, they may slow down, but we think they're sustainable.
And let me just call out, if I may, that the debt that we're securing at this time is construction financing. That's a shorter term loan, typically 3 or 4 years amortization, clearly affected by the interest rate increases. But if we moderate downward, that's a hope and an assumption that when we're seeking permanent financing, those rates may be potentially lower. That would be after stabilization, after construction, stabilization, we'd seek permanent financing. Could be a different market, different rate environment for sure. Sandy, question for you, and I launched that poll. Thank you for answering. What kind of protections are in place for investors as you build these, particularly the subscription documents? These are Reg D securities offerings. Just maybe highlight 1 or 2 protections for investors in these funds.
Well, yeah, I mean, understand these funds consist of 2 parts. One part is the fund documents themselves, and those are documents that we have the standard protections for investors. Your investor advisory board that's in there. As I mentioned, there's also a GP advisory board that you guys eat the cost of that adds extra gravitas to you, whatever you choose to do, I mean, they're people that you can really talk it out with that care. So as opposed to just general, hey, the market's doing great, type of advice. So that's I think a real thing. The second part are your joint venture documents that you have with these operators, with these developers, these 4 developers that you have. Now, these are 100-page documents, and they're the best that we have in our stable that we offer. I mean, these are documents that have been penciled out by the biggest developers in the industry, et cetera. So we use those, and they give us lots of controls, lots of tying the developer to the budgets, to the business plan. If they're out of scope, out of plan, we have self-help remedies, and more importantly, we have self-help talent in you guys, because you've had such experience with this. And that's really important. This is not just a tax game. You guys know the business, and you really need to know the business. The people that we're seeing getting hurt. Jim Lang and I, as we run this here, we've done $10 billion of deployments. Okay, there are people at your end of the bell curve, and there are people at the other end of the bell curve that really don't know what they're doing, and we're finding a lot of that coming to market to us. Okay, to people like you. So those kind of protections I think are very important. Your teaming that you do with Novogradac, who's #1 in the industry. With us, we like to think we're there. Your administrator, and your team yourself. So who manages the developer. Long answer, a lot of protection.
Good response. Thank you, Sandy. And if I may also offer, we self-imposed our own audit. We thought it was in the best interest of our investors. That audit is conducted by Novogradac. And then we do routine OZ compliance testing, which ensures that you enjoy all the tax benefits we all expect to earn over the holding period. John, there continues to be questions around the extension. So I just want to clarify, if I'll kind of frame it as a statement and you can just acknowledge. So if I'm already invested in an OZ, I'm going to get the uptick in, assuming I have either 10% or 0 step up in basis, I'm going to pick up now 15% on a prior investment and move my deferral of the tax to 2028. Is that a correct statement?
That's correct.
Thank you. And so if I'm a new investor to the program, and the legislation's passed, I'm going to immediately qualify for deferral through 28, and then I'm going to get the 15% step up in basis. Is that correct?
That's correct.
Okay.
People, Jeff,
Assuming it
people just-
passes.
Jeff,
Assuming it passes.
understand, the investor still has to be careful about the 180-day rule and getting.
Well, yeah, we haven't talked about the 180 day, but just
So you
think-
don't want to wait, you talk to your tax
Yeah.
people. Because
So,
you
yeah.
don't want to wait for the legislation if you got a timing problem.
Yep.
'Cause you have to invest within 180 days.
Right, and
Recognize
that's
them.
something we didn't discuss, but as I mentioned at the opening, you generate a gain short or long term. Thereafter, you have 180 days to invest in an opportunity zone to qualify for the tax benefits, not 181 days. And that's we hit that timestamp diligently each and every time with our investors. So thank you for reminding us.
And special rules when you get a K1 that can extend.
If you
when
have a
get
partnership.
K1 that can extend that a bit.
That's right.
We'll talk about that separately.
And if anyone has a complex transaction, we go to Novogradac to get a disposition, kind of a forensic review of that gain and get the best advice. So anyone can come to us on that subject. Leo, we're getting a question on the BTR category, built to rent. How does it compare to traditional multifamily in terms of, well, it says specific to OZs. So what we like, I'll just kind of offer a partial response. What we like about the BTR product is that the sponsor is already considering a holding period greater than 6 or 7 years. And, of course, we have a 10-year holding period. So there seems to be better alignment on the timing. But Leo, do you want to talk about how BTR compares to traditional multifamily, either, generally from a return perspective or in OZs?
Yeah, the return parameters, at least our underwriting to date for this project, for instance, is on par with our other projects. We do think there's potentially more upside, but just suffice it to say, we are solving for a net return to our LPs for the fund in general. And this is, right in par with those other investments. The one downside risk for this product type is that you could, as an exit strategy, sell off each individual home because they're all separate tax lots. So as I mentioned before, there are, funds and groups out there, there are REITs that are looking to acquire these projects at a certain time frame. And our goal would be to sell it after the 10-year horizon. But as a downside, if those investors aren't out there, you could sell these as individual homes as a worst case. So that's the only difference, where multifamily, you're selling the entire project. Here, you could sell one at a time, which would not be our business plan. It would just be a protection in case there wasn't a buyer there.
And I
Well, I
think
think we're moving-
on most of them, one second, Leo,
Mhm.
on most of them, lower rise type as opposed to multifamily, which is high rise and more difficult to develop.
Yeah, it is, some markets, and that's a good point, Sandy. I know we're on our time, but this particular submarket has a very high barrier of entry. And that's why we liked it. It's very hard to get permits in this market for build for rent homes. Phoenix in general, not so much. So that's why we were, a little bit, radar was up in Phoenix, because we've passed on a lot of projects there, because you can continue to build as you go out and out. But yes, there's single family rental. There's townhome rental, which is under the build for rent. There are some 3 and 4 story kind of separate buildings that are built for rent. These will have separate garages, separate homes. So true single family and or townhome with their own garages.
So I do think at the top of the hour, let's put a wrap on this. And I want to thank Sandy and John for joining us. And I hope the audience sees that we really do have kind of blue chip expert practitioners around the table. We're always available for consultation. Pleased to announce that the fund to 4 is now fully identified and in the portfolio. If anyone wants to dive deep into the underwriting, look at the interest rate assumptions and vacancy rate assumptions, et cetera, that is what we do, full transparency and visibility into the underwriting. And then if there's any sort of legal structuring or tax related questions, come to us and we'll get to the experts here, John and Sandy for sure. And so I hope everyone's got some significant value from this presentation today. So thank you for your attention and your time.